Welcome. In this video, can Zbcn coin make a 2000% bullish attack? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
When drawing Fibonacci from the bottom to the top, the fact that the price has held at the 0.382 level is a very important detail in terms of technical analysis, because this level is usually the first major correction point in uptrends and is one of the stops needed for the price to progress in a healthy way. After an upward movement in the market, some investors usually take profit, which causes the price to pull back. However, this pullback does not usually mean a permanent decline. On the contrary, it is a pause and a recharging process necessary for a stronger rise. The 0.382 level represents a critical threshold both for short-term buyers stepping in and for new investors to enter the market with confidence. If the price is holding strongly here, it shows that buyers are still dominant in the market and that the trend is likely to continue. When a bounce comes from this level, it is strong evidence that buyers have regained control of the market. The price holding at this level also creates a positive psychological effect on investors because many traders follow Fibonacci levels, so levels like 0.382 collectively become buying zones. This is a self-sustaining mechanism of the market. In other words, the reason these levels determined by technical analysis become strong is not only mathematical calculations, but also the fact that they are followed by millions of investors worldwide. Therefore, when the price holds at 0.382 and bounces upward, both mathematical and psychological confirmation are received. This makes it more likely for the price to move toward its next targets, the 0.5 and 0.618 levels. For investors, this also shows that the trend has made a healthy correction and has the potential to continue strongly. If the price starts an upward move from the 0.382 level, it means buyers have taken back control, and this usually marks the beginning of a move toward higher highs. In addition, support coming from the 0.382 level strengthens the momentum of the trend, because the price rising again without pulling back too deeply signals that there is still strong demand in the market. Especially in the cryptocurrency market where sharp fluctuations and corrections occur, holding at the 0.382 level becomes even more valuable. This shows that the market is not panicking and selling, but instead is finding balance at a certain point. Such situations are often seen at the beginning of long-term uptrends. In other words, after the price makes a rapid rise from bottom to top, pulling back to the 0.382 level for a short-term correction, and then bouncing upward indicates an even stronger upward trend. At this point, technical analysts predict that the price will retest the previous high, break it, and move to higher levels. Also, holding at this level creates a safe buying zone for investors. Many investors place their buy orders here believing the price will move upward from this point. This causes the price to react upward quickly from the 0.382 level. Especially traders who buy at such levels usually open positions with lower risk, which increases the importance of these levels even more. Because if the price does not bounce here and moves downward, since stop-loss levels are close, investors' losses remain limited. This makes the 0.382 level attractive both technically and in terms of risk management. In other words, the price holding at this level is not only a technical indicator, but also an important point of confidence in terms of investor psychology. Especially in a strong bull market, a bounce from the 0.382 level shows that the trend is very strong and that buyers are seriously dominating the market. Because in strong trends, prices do not make deep corrections, they can continue to rise without even pulling back to levels like 0.618 or 0.786. In this case, a bounce from the 0.382 level signals that the uptrend can continue without losing momentum. Therefore, holding and bouncing here becomes not only a short-term but also a medium and long-term bullish signal. This signal increases investors' confidence and speeds up capital inflows into the market again. This cycle makes it easier for the price to reach higher highs. In conclusion, when drawing Fibonacci from the bottom to the top, the fact that the price has held at the 0.382 level and bouncing upward shows that the trend is going through a healthy correction process, and that the probability of the rise continuing is strong. This level represents a critical threshold both technically and psychologically. The price reacting upward from here confirms buyers' dominance and confidence in the market while increasing the likelihood of a strong rise toward higher levels. In other words, this situation is seen as the beginning signal of potential future rises and becomes one of the most important technical factors guiding the market. That's why the price holding at the 0.382 level is interpreted as a big opportunity and a positive sign that the trend will continue. But we can't make a decision based on Fibonacci alone. So let's take a look at other metrics too. Keep watching.
A falling trend structure in the RSI indicator is one of the most striking elements of technical analysis because this structure actually helps us understand the hidden energy of the market, its strength, and the direction of the price. RSI, the Relative Strength Index, is an oscillator that allows investors to determine whether the price is in the overbought or oversold zone. However, in addition to levels, trend lines on the RSI are also of great importance. Just like on the price chart, rising or falling trends can be drawn on the RSI, and the breakout of these trends can give strong signals about how price movements may proceed in the future. If there's a clearly falling trend in the RSI, this shows that the market is losing strength, buyers are weakening, and sellers are in control. However, the moment the RSI breaks this falling trend, meaning it moves above the trend line, this indicates the beginning of a new attack and a new rise in the market. Because the indicator shows that investor psychology is slowly starting to change, buyers are regaining strength and sellers are losing control. The breakout of a falling trend on the RSI often indicates that the price will directly gain upward momentum. Therefore, seeing this structure is exciting for investors. Because the price chart does not always give clear signals, sometimes consolidations, sideways movements, or sudden fluctuations can be observed. But the existence of a falling trend in the RSI and its breakout is a strong sign that predicts the direction of the price in advance. At this point, the RSI trend breakout gives an early signal of possible rises that may occur on the price chart. While the RSI moves in a falling trend, each peak forms at lower levels than the previous one, showing that the market momentum is weakening. However, once the trend is broken, this chain of lower highs is disrupted, and the message is given that market momentum will start to shape upward again. The moment the RSI breaks its falling trend, the price's upward attack begins because a fundamental transformation takes place in investor psychology. Especially if a long-standing falling RSI trend is broken upward, its impact on the price becomes much stronger. Investor confidence increases, belief in the market's upward movement strengthens, which increases trading volume and paves the way for the price to make a rapid upward move. That's why falling trend breakouts in RSI are considered reversal signals in technical analysis and symbolize an attack time for the price. After this breakout, the price usually not only starts a short-term rise, but also a medium to long-term rally. Because while the RSI trend breakout shows that momentum has turned upward, this momentum is reflected in the price chart and becomes the beginning of a new uptrend. One of the most important points to note here is that the RSI trend breakout is not just a level breakout, but actually shows a change in the collective behavior of investors. In other words, seller pressure decreases while buyer appetite increases. As this appetite grows, it becomes inevitable for the price to move to higher levels. Falling trend breakouts that occur between the 30 and 70 levels are considered healthier because in this zone the RSI is neither overbought nor oversold. Therefore, the breakout shows that the market is undergoing a natural and healthy transformation. If this falling trend is broken while the RSI is already in the oversold zone below 30, then a strong recovery signal is formed for the price. This means the price has gathered strength at the bottom levels and is ready for a big upward attack. Conversely, if the RSI breaks its falling trend while near the overbought zone, it is more likely for the price to start a new rally because buyers are already strong and gain even more momentum with this breakout. The falling trend breakout in the RSI is also of great importance for investors' strategies. For example, if an investor has been waiting for the price to rise for a long time but cannot see a clear signal on the price chart, the falling trend breakout in the RSI gives them confidence, because this breakout tells them the attack time for the price has come.
The inverse head and shoulders pattern is considered one of the most powerful reversal formations in financial markets and is often taken into account in investors' long-term strategies. This pattern usually appears at the end of a downtrend and provides a strong signal that prices may have already left behind their bottom levels and could begin an upward trend. In the scenario you mentioned, the price being in the stage of forming the final shoulder actually represents one of the most critical and exciting phases of the formation. At this stage, both technical indicators and investor psychology are tested intensely. The inverse head and shoulders formation consists of three main structures: the left shoulder, the head, and the right shoulder. In the first shoulder, the price declines, then partially recovers with a rebound, but this recovery is not sustainable, and another, stronger decline begins. This decline forms the head, which is the deepest point. After the head is formed, a strong rally follows and the price approaches the neckline again. Then comes the third stage, the right shoulder. The right shoulder is usually similar in depth to the left shoulder, but not as deep as the head. During the formation of the right shoulder, we can see that selling pressure has started to weaken and buyers are gradually taking control. Once the right shoulder is completed, attention shifts to the neckline. The breaking of the neckline marks the confirmation of the formation. When calculating the price target after the breakout, the distance between the head and the neckline is taken into account. In other words, the vertical distance from the head to the neckline is projected upward after the breakout, and technical analysis suggests that the price may move upward by that amount. As you pointed out, in this scenario, the target offering a massive potential return of 2,000% indicates that the formation is developing on a very large scale and points to a major trend reversal. A target of around 2,000% usually appears on long-term charts such as weekly or monthly timeframes. The emergence of such a target means that the price could undergo a significant transformation, shifting from a long-term downtrend into a strong uptrend. Looking at investor psychology, the process of forming an inverse head and shoulders pattern involves an intense emotional cycle. With the decline in the left shoulder, many investors panic and market confidence is shaken. Then, during the head's deeper drop, despair reaches its peak. This is actually where the biggest opportunities arise, because most investors have given up, sold their positions, and the price has reached its lowest levels. As the right shoulder forms, selling pressure diminishes, and investors start to show renewed interest, signaling the market's readiness to recover. From a technical standpoint, once the formation is complete, moving the target price upward by the head to neckline distance is considered a highly reliable method of analysis. What matters most is a clear breakout of the neckline. Before the neckline is broken, the formation is only a possibility. After the breakout, it becomes a strong confirmation. Volume is also important. Typically, when the neckline breaks with increased volume, it signals the sustainability of the uptrend. If volume is low, the breakout may not hold. But if it comes with high volume, the rally is far more likely to continue strongly. At this point, the mention of a 2,000% target in technical analysis is not only a price prediction, but also a message about the scale of potential in the market. Such a massive rally is not just a small correction, but a long-term macro trend reversal. If this scenario plays out, investors would witness the beginning of a bull market that could last for many years. Additionally, patterns like this should not only be evaluated from a technical analysis perspective, but also in terms of market psychology and investor behavior. During the right shoulder's formation, indecision often dominates the market. Many investors fear the decline might resume. However, for experienced investors who recognize and track this formation on the chart, the right shoulder actually represents a period of great opportunity. This is one of the best times to take a position before the price begins its rally. Once the right shoulder completes and the neckline breaks, the market typically accelerates upward. Entering at this stage becomes much riskier since the price has already taken off. Therefore, investors who monitor the formation in advance have a significant advantage. A 2,000% target does not only offer extraordinary returns for small investors, but also creates massive opportunities for large institutional investors. Behind a rally of this scale, there are usually not only technical reasons, but also macroeconomic and fundamental drivers. For example, the adoption of new technology, global capital inflows, major economic policies, or sectoral transformations often support such large moves. This means that while technical analysis points to the target through the formation, the actual realization of that target is usually reinforced by fundamental analysis. The inverse head and shoulders pattern in this sense is not just a graphical structure, but also a reflection of market cycles. While fear, panic, and despair dominate during a downtrend, once this formation completes, hope, confidence, and bullish expectations take control of the market. This transformation changes not only investor psychology, but also the direction of prices fundamentally. For long-term investors, the completion of this formation often signals a major shift in portfolio strategies. While investors may have been more defensive during the downtrend, the confirmation of the pattern can lead them to adopt much more aggressive buying strategies. Some even view the confirmation of the pattern as the beginning of a new bull season. The 2,000% target you mentioned supports exactly this perspective, as such a rise is not just a small recovery, but the start of an entirely new market cycle. Another advantage of such massive targets is the reward they provide to those who wait patiently. Investors who position themselves during the right shoulder and wait for the neckline breakout are usually rewarded greatly in the long term. In technical analysis, the larger the time frame on which a pattern forms, the stronger and more reliable the target becomes. While an inverse head and shoulders on a daily chart may offer short-term opportunities, those forming on weekly or monthly time frames signal long-term trend reversals. The mention of a 2,000% target suggests that the formation is indeed developing on a much broader time frame. In conclusion, the inverse head and shoulders pattern is considered one of the most reliable reversal patterns in markets. The fact that the price is currently forming the last shoulder indicates we're very close to the completion of this structure. If the neckline breaks and the formation is confirmed, a potential rise of 2,000% could occur in the upcoming period. This represents not only a technical opportunity, but also a historic chance in terms of investor psychology and market cycles. Reading the formation correctly, being patient, and closely monitoring critical levels are the key factors in this process. In this way, the massive transformation opportunity offered by the market can turn into an extraordinary profit gateway for investors.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.